Hello, and welcome to another episode of the Markets at a Glance series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So once you join in, kindly say hi on the live comment section, and that will confirm that everything is working just fine. So it has been quite a crazy week, a lot of volatility since Monday, as we processed the news of the collapse of the Silicon Valley Bank, as well as Signature Bank. So we know that there are 3 banks in the US, though not the biggest banks that collapsed over the weekend. And on the wake of Monday, we saw a lot of volatility in the markets. And just about 30 minutes ago, we saw the US inflation data, and that's what I want us to focus on today. So we'll be doing a brief highlight of what happened during the SVB saga. And once we understand that, then we try and understand how the investors are processing the most recent news, and that's the US CPI. So without much wasting much time, let's jump right onto it. So as you can see, we didn't have much happening in the markets on Monday. And today, being Tuesday, we had some data early in the morning. We saw the claimant count change in the UK. And this is the number of people who are claiming for unemployment insurance, dropping by 11.2K, which was healthy, indicating a strong UK economy. So in the previous reading, it was a negative 30.3K, so also a drop. And the expectation was a rise in the number of unemployed people. So the average earnings index, quarterly over yearly, dropped to 5.7% from 6%. This is good, especially for the Bank of England that is looking to lower inflation. So whenever you see earnings index slowing down, then that's positive for the Bank of England. However, for the people, it's never desirable when earnings are going down. So unemployment rate remained steady at 3.7%. And also producer price index for Switzerland came in at a negative 0.2% compared to 0.7% rise in the previous month, also indicating that inflation is getting in line with expectations for Switzerland. So Italian industrial production was up 1.2% in January. This time it's slowed down to negative 0.7%, not good. So we'll be looking at further data from other countries within the Eurozone to get an understanding of what's happening. So Canadian manufacturing sales up 4.1%. So this was a big surprise compared to the previous reading of negative 2.1%. So this is very positive for Canadian equities, and also negative for the Canadian dollar. So the most important news for the day was the US inflation data report. So came in 3 measures that investors focus on. One is the monthly change. Remember, CPI is a short for consumer price index, which basically measures a basket of products that are consumed by the average household in the US, and then compares prices month over month. So in the previous reading, there was a big surprise where we saw inflation spiking by 0.5%. And on the year, we saw a slight drop from 6.5% to 6.4%, and that's the previous month. So this time, there was a slight increase of 0.4%. So it's a literal slowdown in inflation, but at the same time, it's still a big jump higher. So if you look at these numbers here, you'll notice that there was this period when inflation was consistently pushing higher, then dropped and kept a low level. Then on this particular reading in January, which was reflecting December, prices actually went down for a bit by negative 0.1%. And this is when Jerome Powell basically mentioned that, that the US had entered a disinflationary period. However, just a month later, that was now in February, we saw a big spike of inflation, which was up 0.5%. And now for the February data, we are seeing a spike of 0.4%. So the thing is, this is slightly lower than the previous month, but yet it's still a big number. It's still a big rise, though not comparable with the rises we saw back in July, 1.3. We saw a big rise in June. We saw a big rise in April. This was around, I think this is 1.2. So it's still within limits or within expectation, but yet an indication that consumer prices continue to rise. So this number that we saw at the beginning of February was enough to rattle the Fed. So when we listened to Jerome Powell in his latest speech, he basically mentioned that this inflation is getting worse, and it's very important that they continue doing the job of raising interest rates until inflation drops towards the target rate of 2.0%. So on the year, and this is the data that a lot of investors are focusing on, it's still a significant drop. This is actually the 8th month that the US has been dropping consecutively since the peak in June, which was 9.1%. So we have 1, 2, 3, 4, 5, 6, 7. This is the 8th month that we are seeing inflation continue to drop. So remember, the target is all the way down to around 2.0%. So we are not yet even halfway downward from 9.1 down to 6%. If you look at the path to go, we expect a further 4% drop until inflation gets to the target level of 2%. So this is still significantly very high inflation rate of 6.0%. And the Fed is expected to continue with the job until inflation gets to 2%. So what this means is that if the Fed keeps on increasing interest rates in order to push inflation downwards, then the overall effect is that the dollar becomes scarce and gains value, whereas US equities continue losing. So there was a mixed reaction to this data. You can see it's a good performance from 6.4% to the expected value of 6.0%. But then there's also the issue of core CPI. So core CPI refers to the basket that is measured in the CPI. And once you subtract the volatile items, which is food and energy prices, then you are left with a core CPI. So it's a much more stable measure of inflation since it doesn't include the volatile items. So in the previous reading, it was 5.6%. This time it dropped 5.5% on the year. Apologies for my voice. And also, if you look at the month-over-month change, this was a 0.5% gain compared to the previous month of 0.4, which is indicating that inflation is on the rise. So while the overall CPI maintained the path going downwards, the core CPI is now changing direction and moving upwards. And this is one of the worries that the investors were concerned about. So as you can see, in December, core CPI jumped by around 0.2%. Then we had a 0.3% in January, 0.4% in February, and now in the March reading, 0.5%. So this is not a good picture. It's an indication that inflation is getting entrenched. And if it continues rising, then the Fed will have to fight harder to get it to control at 2%. So we know that oil prices have been going downwards for quite a period of time now. And I just want to illustrate this. So I want to show you the path that oil prices have been taking. Just a moment. Yes, we got the oil chart here. So as you can see, for quite a large number of months, oil prices have been going downwards. If you count the number of months, it's one. This is from June last year. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So for 10 straight months, we have only had 1 month when oil prices were moving higher. So with oil prices consistently pushing further downwards, we know that oil has a direct impact in consumer prices. So whenever oil prices are high, then consumer prices tend to go higher. So with this record that we are seeing here of 10 months that the market is consistently pushing down, then the overall expectation is that consumer prices in the US also continue experiencing the same pressure. So now when you don't count the oil and food prices, which are getting back to normal, you realize that there's a problem with housing where rental prices are continuously moving up, which is basically inflating the CPI basket. So this explains why we had a mixed reaction. And the mixed reaction was after the data was announced. So this is what happened with the dollar index, shot all the way up and then back down, and then all the way up, and then all the way back down, and then up, and this is the current price right now. So this is a clear indication of what we call mixed reaction, and the description on the charts is often called a whipsaw. So a whipsaw is when the price moves in both directions within a very quick period, and when that happens, it basically tells you that something is happening and investors are not yet sure of the direction to take. So, so far, it has also happened in currencies. So if you look at the pound USD and how it has reacted, shot down and then up and then down and then up, down, and this is the current price level. So if you look at New Zealand USD, same case, shot down, up, and this is the level. Euro USD, shot down, up, and this is the current level. So it's a similar case across board. So it's a mixed reaction. People don't know what to take of the inflation data. So now, if we narrow down this and focus on the actual report, and this is the actual report, I'll try and share it with you so that if you want to go through it some other time, then you can do it. So I'm seeing the crying emoji from Kevin responding to the movement in Australian dollar against Canadian dollar. We'll check that out. Hello, Johnson. Thank you for joining the session. Let's keep it going. So this is the actual inflation consumer price index report with the summary. So I want to head straight to the data. And as you can see, this is the items. This is the data from August 2022, September, October, November, December, January, and February. So for all items, as you can see, for August, there was a slight rise of 0.2, September 0.4%, October 0.5%, November 0.2%, DEC 0.1%. January, this was the big spike that caused the Fed to consider continuing hiking interest rates and changing stance from disinflationary stance to inflationary period, in this case addressing the high inflation. And now you can see the inflation is slightly lower in February than January, but still significantly higher than the previous months, which had 0.1, 0.2, 0.5, 0.4, 0.2, on average in between 0.2 and 0.3. So overall, annual inflation stood at 6.0%, and this is a good drop on the year. But then you can see that food inflation on the year was still high at 9.5%, whereas food away from home was also up 10.2. Energy prices were up 8.4, whereas energy commodities 5.2. Energy gasoline, sorry, this is energy commodities which were down 1.4%. Gasoline, all types down 2.0%. Fuel, that is oil, up 9.2%. Energy prices were up 13.3%. And also, if you look at electricity, which is a utility, it was up 12.9%. So piped gas service was up 14.3%, indicating that these had the highest weight among the list here. Then you look at all items, less food and energy. This is what we describe as core inflation. It had 0.6% and then 0.6%, which narrowed down to 0.3, then 0.3 started rising to 0.4, 0.4, and now 0.5, indicating a curve that started from a very small number and now is rising at 0.5, almost back to the August level of 0.6. So this is quite a big worry in the market. It's indicative of rising inflation. So commodities less food and energy commodities were up 1.0%. New vehicles up 5.8, whereas the used cars had a very strong slowdown of negative 13.6. So apparel, this is clothing, 3.3, medical care, 3.2, and then a big surprise with services, less energy services. So when you talk of services, less energy, you're basically talking about shelter. So in this case, you can see it was up 7.3%. So shelter individually up 8.1, and this was the biggest contributor to the inflation number, that is the core CPI. So transportation services were also up 14.6, and also Medicare services were up 2.1. So as you can see, for the items in focus, mainly energy as well as food, they had a slowdown on the previous month, but that did not mean much since investors are also focused on the core CPI, which saw a much bigger print than we expected. So as a result, we saw the mixed reaction, and now the focus moves to the Fed on the 22nd. So this will be on Wednesday next week. This is when we'll be expecting the FOMC to be meeting and announce US interest rates. And we know that they're also looking at the same data. So there is a good chance that they could go for a 25 basis point hike or even a 50 basis point hike. And now, as they consider the data from the US economy, they will also be considering one new data point, and that is the collapse of the 3 banks in the US. So the Fed has a mandate, and the mandate is pretty simple. And the mandate is to stabilize prices in the US economy. And also they have a mandate to ensure full employment. So as long as unemployment rate is below 4%, the US is considered to be under full employment. So that goal has already been achieved. So the main goal that the Fed is looking to achieve is lowering inflation to 2%, which is considered a good level to stabilize prices. So now we know that the Fed is fully focused on dropping the current inflation from 6% to the target 2%. However, if the US banks are breaking as a result of the high interest rates, then that works against the Fed's goals. So the Fed could continue raising interest rates, but if the result of that is the banks collapsing, then that will not achieve stable prices within the US economy. So that has to be addressed too. So it's a new factor in their cocktail of data that they consider before making an interest rate decision. So with the case of Silicon Valley Bank, we know what they did. They put a lot of their money in US 10-year bonds during 2020, 2021. But then now they are overstretched because customers are withdrawing money from their bank. And as they are stretched financially, they were forced to sell their at par bonds at a loss in order to cover withdrawals. And once the market realized that was happening, there was panic and people went to withdraw their money, eventually forming what we call a bank run. And when the bank run happened, they could not honor all the withdrawal requests, which automatically set the bank under receivership, which is now under control of the FDIC, or what we call the Federal Depository Insurance Corporation of the US. So President Biden issued a speech yesterday, and in his speech, he mentioned that all depositors will be covered by the FDIC. So anyone who had monies deposited with those banks will be able to withdraw all their money. But then the investors took the biggest hit. So a lot of banking stocks were losing for the day. And with that happening, there was a massive panic across the banking sector as investors realized that more and more banks were holding unrealized bond losses. So That remained the theme of trading as per yesterday. And today we could be seeing a continuation of the same. So as much as we know that the Fed provided a credit line for banks having such issues, where instead of liquidating their bonds at a loss, they can borrow short-term from the government, then in this case, we will be expecting some blood to continue happening in the bonds markets, as well as the equities of those banks. So some of the banks were down 78%, others 60%, 50%, and so on. So during the market open, we'll be looking to observe to see whether there is a continued selling of these banking stocks. So a nice place to check the performance will be on FinViz. It's usually a very nice website. So remember, the market opens in the next 9 minutes. So we could be seeing some good volatility coming from that. So as you can see, this has been reset. We are not seeing any changes because the market is not yet open. But then immediately the market opens, then you'll be seeing the top gainers, top losers, and all that. So it will be a pretty impactful session. So some of the items to watch will be the top trending stocks yesterday. We will be looking at First Republic Bank, which had a big loss yesterday. We will look at Western Alliance Bank Corporation. We will look at Metropolitan Bank Holding Corporation. There is a Genelax Corporation, iCard Medical Services, and then First Foundation Incorporated Bank. There's also KeyCorp Bank, First Foundation Incorporated Bank, and so on. So these regional banks in the US were bleeding heavily yesterday. So going forward, we'll be expecting some similar action today, or even some form of reversal, but I expect a continuation of the same. So besides these, we might also be looking at the US two-year bond. And this is basically to try and understand how the market is pricing in a potential rate hike. So a nice trick is just to look at the yield on the US two-year bond. And once you get the yield data, apologies for that. Just a moment. Getting out of problems with my adblock here. So this is how the US two-year bond was performing yesterday. A very sharp drop followed by a reversal. So let's look at the 1 hour chart. So a very sharp fall from 5.0869. That was the yield on the two-year bond. So it dropped all the way down to about 3.9556, and now has made some recovery. It's at 4.2859. So the way we do this is by comparing what we have as the federal funds rate, which is currently at 4.75%. So if the yield is at 4.2859 in the market, then you subtract that from the Federal Reserve, then the outcome is much closer to the 50 basis point hike. So currently at 4.2859, if you add 50 basis points, then you'd get to 4.7859, which is very close to 4.75%. So in this case, it basically means that the market is pricing in a 50 basis points rate cut. So it's not pricing in a rate hike, but rather a rate cut. So before that, the expectation was that the Fed would go for a rate hike of 25 basis points, which would push the interest rates to around 5%. But now the market is pricing in a 50 basis point rate cut. So with that in mind, we'll be looking at more data coming from the US before we get to the next week meeting from the Fed. So as per now, the expectation is for a rate cut. And with this expectation for a rate cut, we know a rate cut would weaken the dollar and strengthen equities. And that may explain why we have a good rally happening today in the S&P 500. So clearly, you can see even after the inflation report had mixed reactions, the following 30 minutes have indicated strength in the S&P 500 and confidence that the market will start going up. Similar case for the Dow Jones, eventually breaking out outside this triangle. And also for the US Tech 100, we are seeing the market test a very important resistance level. So these are a resistance level that has held true for quite a period of time. So if I was to remove these, then I'm expecting that if there is a break, we could be seeing some continued bullish activity. So if I go for the H1 chart and then I zoom, you can see we are coming back from this strong support that was hit yesterday. And now we could be seeing the US Tech 100 begin to rally. So a break above 12,077 would see us cruising even higher. So potential bullish positions could be identified on the 15 minutes chart towards the upper side. So it's just about observing the price action here. And if there's a break, then go for a bullish position. If there's a bounce, then go for a bearish position. So that's it for today. Thank you very much, guys. Thank you for your time. And I hope to see you on the next session on Wednesday. So I'm seeing some comments here from Mana, learning something. The market is crazy. Yes, it is. Is it better to stay away now while the market is having mixed reaction? Yes, it's always best. But I think we are seeing unidirectional movement in US equity indices. So just observe the US equity indices. Maybe there could be some positions that present themselves during this New York Open. So I think the softening of inflation is too slow. The Fed have to come in as promised by Powell. Yes, absolutely. The Fed has to go for a 50 basis point hike. And in that case, we'll be seeing the dollar strengthening and equities weakening. But then since the bonds market are pricing in a rate cut, then there's a lot of confusion in the market right now. So thank you very much, guys. I hope to see you on the next session.